This podcast is for educational purposes only and is not financial advice. Welcome to the 15-Minute Investor. Today we're covering a crucial convergence of global forces. The immediate signals from the Federal Reserve, the unprecedented media consolidation embodied by the Netflix-Warner Brothers deal, and the accelerating geopolitical scramble for resources driving the AI energy crisis.
That's a lot to unpack.
It is. We have four major stories that are secretly interconnected, and they're signaling a potential ground shift for investors leading into 2026. This is really where macro strategy meets market reality.
It truly is. This is a unique moment where you have political strategy, massive corporate debt, and the sheer scarcity of physical resources all fighting it out on the same financial battleground.
So for you, the listener, understanding how these pieces connect is the key.
It's the shortcut to strategic positioning, absolutely.
Okay, let's start with the most immediate variable, the one influencing every decision right now, the Federal Reserve.
A huge week.
Huge. We have the FOMC meeting this Wednesday, which always drives volatility, and it's coupled with the latest producer price index data, so we'll get a sense of inflation pressure.
And all eyes are on interest rates, of course.
Of course.
That's right. And the market isn't just anticipating an action. It's largely priced in a very specific action.
The 0.25% rate cut.
The 0.25% rate cut this week, yeah. If the Fed follows through, that quarter-point cut brings the Fed funds rate down to 3.5%, which, aligns almost perfectly with their own projection.
So it's almost anticlimactic.
In a way, yes.
Right.
Its predictability is the point.
So if the immediate cut is essentially baked into the cake, where should our listeners be focusing their energy for the real market move?
You should view this week's cut as just clearing the deck. The real focus, the thing that matters, is 2 months out. It's the January meeting.
Okay.
Right now, the probability of another rate cut in January is sitting at, around 24.8%?
That's low.
It's low enough to signal real uncertainty. Any shift in the Fed chair's language this week could send that number flying, one way or the other, and that will set the mood for the market.
And we know the three scenarios that could play out. If the Fed signals slower cuts, the market dips.
Dips. If they signal a steady pace, the market pops.
But the big one, the one that would spark true investor euphoria, is fast cuts combined with the Fed turning on the
money printers. Quantitative easing.
Right. Let's just quickly define that. Quantitative easing, or QE.
Sure. It's when the Fed injects liquidity into the system by buying up bonds and other assets. It expands the money supply, lowers long-term interest rates.
So fast cuts plus QE.
That would set the stage for a really powerful year-end Santa Claus rally, just based on all that liquidity.
And it's important to look past the glam and glory of the stock market for a second.
I look at the bond market.
Exactly.
Absolutely. The bond market has been quietly ticking up, which suggests rates might stabilize faster than people think. And remember, the bond market is often the real market.
Because it's institutions trading on debt, not hype.
Precisely. Its signals are clearer, less emotional. It tells you where the system really thinks things are headed.
Now, for those of you actively managing risk around the meeting itself, there's a historical pattern with the FOMC announcement.
There is.
Volatility, the VIX, is usually up the day before. Markets are generally up too, in anticipation.
But the day after is a total coin flip. It offers no clear signal at all. The driver becomes the press conference.
And here's that investor nugget that seems to hold true every single time. It's about the Fed chair's Q&A.
Oh, yeah. The longer they talk.
The more the market tends to dive. Why is that?
Because reporters are fishing for a hawkish slip-up. A comment that suggests the Fed might be less accommodating than everyone hoped. So every extra minute just increases the odds of that happening, and traders start selling.
So if the macro environment is tightening because of rates, even if they're about to tick down, that cost of capital just has a massive impact on corporate decisions.
It does.
Which takes us straight to our next story. Massive corporate consolidation. Let's talk about Netflix.
This was arguably the most seismic event in the media world this year. Netflix outbid Paramount.
And acquired about 3/4 of Warner Brothers' assets. This wasn't just buying a library, was it?
No. This was a move toward massive cultural consolidation.
The valuation was just staggering, an $82 billion enterprise value. But the key isn't the price. It's that Netflix is shifting from renting content to owning the world's most valuable IP.
The entire HBO catalog, Game of Thrones, Harry Potter, the whole DC franchise, the Warner Brothers film studio itself, it's a monster deal.
The scale is almost funny. Netflix's annual revenue, what is it, $43 billion?
It's around there yet.
That now surpasses the entire global box office.
Which was about $30 billion last year.
Right.
The theater industry is just dwarfed by this new entity. Netflix is, for all intents and purposes, becoming the new Hollywood.
Okay, so with that kind of scale, that kind of IP acquisition, the market reaction was completely counterintuitive. The stock fell.
It fell hard.
How do you square that long-term strategic win with a short-term stock drop?
It comes right back to our last topic, debt and complexity, driven by high capital costs. Netflix has to assume a huge chunk of Warner Brothers' massive debt load.
Okay, that's fine.
And two, a deal this big is going to get intense regulatory scrutiny. It could take 12 to 18 months to clear antitrust hurdles.
So big investors don't want their capital tied up for a year and a half in a high-risk, high-debt situation. They just sell.
They sell. That's exactly it. They'd rather free up the capital, regardless of the long-term value. And you can see it on the chart.
The technicals.
The news pushed the stock right below a very reliable long-term trend line. That's a major warning signal. If it breaks below $193, that confirms a significant outflow of institutional money.
So connecting this corporate debt picture back to global power shifts, we're seeing the foundation for a resource war being laid.
This is where we really connect the dots.
Let's talk geopolitics, lithium, and the hidden AI energy crisis.
Right. This story connects everything from soybeans to currency and ultimately to AI dominance. It all started with a trade dispute. The U.S. criticized China.
And in response, China cut its demand for U.S. soybeans, a $13 billion market.
Yep. They just pivoted their purchasing to Argentina and Brazil.
That seems like a small commodity issue, but the U.S. response turned it into financial chess, didn't it?
A very strategic countermove. The U.S. immediately loaned Argentina $20 billion. But it was a currency exchange, $20 billion US dollars for $20 billion pesos, which Argentina has to repay in USD with interest.
So it stabilized a regional economy.
And more importantly, it blocked China's attempt to build that alliance. It secured a critical new ally for the U.S.
And the real prize secured through that financial leverage. It wasn't soybeans.
Not at all. It's resource dominance. Argentina, with Chile and Bolivia, forms the Lithium Triangle.
Holding over half the world's known lithium reserves.
Over 50%, yes. And lithium it's moved way beyond just EV batteries.
Yeah.
It's essential now for AI server data centers, for energy storage, robotics, satellites.
It's no longer a commodity.
It's strategic leverage. It's resource warfare. It determines who dominates EV manufacturing, and crucially, who controls the infrastructure for AI. And you're seeing U.S. companies like MP Materials and Vulk Elements moving aggressively to acquire direct stakes.
So this scramble for lithium tells us something fundamental about AI's future. It confirms the industry is hitting a ceiling, not because of chips, but because of a massive, accelerating demand for electricity.
The power estimates are, frankly, staggering. AI servers are projected to consume 600 terawatt hours by 2025.
And that jumps to
1,000 by 2030, and maybe 2,500 terawatt hours by 2033. To put that in perspective, that's the energy consumption of multiple major countries combined.
So the U.S. response securing lithium for batteries, rare earths for magnets, uranium for baseload power, it's about strategic survival.
It is. It's a recognition that control of energy equals control of the entire next industrial revolution.
Let's shift focus to some key tech stocks reacting to this, specifically Meta.
Meta had a huge surge last week, and the reason is really instructive for all tech investors.
They cut spending on Reality Labs.
By 30%. And investors immediately rewarded it. The market prefers visible, profitable AI monetization over the high-cost, speculative metaverse burn.
It's a huge signal. Meta is shedding that dreamer label and becoming a serious, profitable AI infrastructure play.
Exactly. The market is telling every big tech company that discipline is what they want to see, not moonshots.
Okay, so let's connect this back to the chip supply that fuels this whole thing. Let's look at Nvidia.
On the weekly chart, things still look good. The 20-day and 50-day moving averages are sloping up, underlying bullish momentum, but there's some time frame misalignment on the daily and hourly charts, a kind of choppiness that suggests trader confusion.
So what's the key inflection point for investors to watch right now?
The key level is $191. We need a decisive break and a retest above that mark. If it clears 191, it gets past a lot of overhead supply, and it has a clean path to target the all-time highs around $212.
And if it fails?
If it fails to hold 191, it might signal capital is flowing out of that pure AI infrastructure play. Caution is needed.
Beyond the giants, we're watching a few thematic setups. For growth, Chipotle, CMG has a nice bull flag setting up.
Suggesting consumer spending is still strong.
And on the defense side, General Dynamics, GD, has a similar pattern, which might reflect a rotation into safer plays amid all this global tension.
Right. And it's worth noting the broader market, SPY and QQQ, both showed what technicians call bearish pin bars recently.
Which suggests hesitation.
Exactly. Selling pressure after a strong run.
Yeah.
For active investors, you have to watch for a break below the SPY low of 684.5. That could signal a deeper consolidation.
So this brings us to our final considerations. Whether you're actively trading or building a long-term portfolio, discipline is paramount.
You have to wait for your levels to hit and hold. Don't chase momentum.
And despite all this volatility we're seeing, the AI industrial revolution itself is still projected to have at least 5 to 7 more years of explosive growth.
That trend remains the dominant macro play for the decade.
And looking even further out, the biggest macro signal is looming in 2026, the selection of the next Fed chair.
That will likely lead to a more dovish stance, more rate cuts, more QE, as a new administration seeks accommodative policies, which is generally bullish for growth stocks and crypto.
So what does this all mean for you as you plan your strategy? Let's recap our top 5 critical takeaways.
First, the Fed. A quarter-point cut is expected, but the market's real direction will depend entirely on signals about the January meeting and any hint of future money printing.
Second, Netflix. The Warner Bros. Acquisition is a massive act of cultural consolidation, but the stock fell hard on debt and antitrust uncertainty, breaking a major technical trend line.
Third, geopolitics. That U.S. $20 billion loan to Argentina was a brilliant, highly leveraged countermove to block China and secure leverage in the vital Lithium Triangle.
Fourth, AI power. The AI sector's massive electricity consumption is turning access to resources like lithium and uranium into a matter of national strategic importance. The new resource war is a power grid war.
And finally, tech shifts. Meta's surge confirms that investors strongly prefer visible AI monetization and cost control over speculative concepts like the metaverse.
The lesson here is that everything is connected. From the interest rate on your debt to the chess game being played over lithium deposits. You know, the debt that scared investors away from Netflix is the same kind of financial tool the U.S. used to secure its future AI energy source. When you see a strategic shift in the market, ask yourself what unrelated action made that possible. History doesn't warn you twice, it shows you the patterns. Thanks for listening to the 15-Minute Investor.